A good investment portfolio is one that meets your needs in terms of return, volatility, and time horizon. Tools like spreadsheets can measure these factors. A good investment portfolio today might not meet your needs in the future. Creating a good investment portfolio means selecting the right assets from the appropriate classes. Analyzing your investment portfolio in such a manner will help you sleep soundly. With the worksheet that you can download down in the description, you can specify the amount of your investment, the amount of leverage, and you can even test the effects of additional volatility. Based on historical data, you can decide if this asset allocation works for you. Again, click on the link down in the description. That'll take you to the inspiration for this video, which is my post, Create Your Ideal Investment Portfolio, One You Believe in. Here, you'll find more detailed information on portfolio construction and investing in companies that you believe in. You can also download the investment portfolio workbook that I'll refer to in this video. With it, also, you'll be able to find my previous video in this series called Building an Investment Portfolio, What to Consider. Rebalancing as needed. After you run through this workbook and get a feel for how you want to allocate assets, you can always come back and reevaluate. Different circumstances are going to call for the creation of different investment portfolios. If you're young, carefree, and have a little bit of extra money that you want to invest, you might take a riskier approach. Maybe you don't care if you lose this relatively insignificant amount of money. However, you do love the idea of being able to turn it into a small fortune. On the other hand, if you're looking how to allocate a sizable sum that represents your entire net worth, you might not have the same stomach for risk. You might want to minimize the odds that you end up with any sort of loss. In order to minimize those odds, you're willing to sacrifice some of your potential gains. Anyhow, if you find yourself with fear of missing out, FOMO, or sleepless nights, then it's probably time to reevaluate your investment portfolio rebalancing. Keep in mind, however, that selling certain assets and buying others might result in unfavorable taxes or other penalties. Download this workbook to create an investment portfolio you can believe in. Complete the form, which you'll find on the link I put in the description, and click Submit. After your email is confirmed, the workbook will automatically open in a new tab. If you've been to my site before, investsomemoney.com, you know that I love creating models. With this investment portfolio worksheet, you can toy with investment amounts, margin, and volatility. Just drop into price history for a given asset. If that's not available, then use the history for one that you think will act in a similar manner. How to use the investment portfolio workbook. First, on the variable and values worksheet, enter the name or ticker or some other description for each asset along with the initial investment. You can enter percent owned, margin, and extra volatility percentages now if you like, or you can enter them later. Percentage owned, or margin, is the amount of equity you have in a position. For instance, if you buy a stock on margin, you'll likely have 50% equity. The other 50% will be borrowed. If you're using something as a proxy, like I did with GRU in my example, which is a commodity, you can also simulate the effects of higher leverage by entering a low percentage owned margin percentage. The extra volatility variable allows you to see what would happen if daily prices changed in a more drastic manner. For a given asset, each will move up or down by an increased percentage you enter here. For example, if you enter 10%, a dollar daily price movement will actually be increased to $1.10. After that, go to the close history worksheet and enter, or copy and paste from Yahoo Finance, which is what I did, the price history for each asset. Try to make the dates match for each row. If you have the skills, you can use the Google Finance function to populate dates and prices using the tickers you enter on the variable and values worksheet. I didn't do so in my example because I wanted to use the adjusted close prices from Yahoo Finance. They include dividends, and I thought that was important to my analysis. Here's the variable and values worksheet. You can see that I entered the name and ticker for an asset so I can identify it, the initial amount I invested in it, the percentage owned. This one I bought on margin, so I have 50% equity in this position to begin with. And I wanted to see what happened if ticker symbol MO were to be 25% more volatile. I did the same for 4 other assets. And then on the close history screen here, I entered the date and adjusted close in my case, which I got from Yahoo Finance for each of these assets. You'll also notice, as I mentioned, that every single date matches here. That's important for the graph on the summary screen. Interpreting the output. On the summary worksheet, you'll see the results of what you entered. Compare your beginning value to the max min total values. Also, decide if you're comfortable with the max min dollar and percent changes. Can you sleep at night knowing that your portfolio could increase or decrease by these amounts? If not, you'd better revisit your margin percentages or consider changing the assets in your portfolio. Finally, if the dollar and percent change data have piqued your interest, then you can enter a custom dollar and percent threshold to see how many days your portfolio met or exceeded those amounts. Here's a look at the output on the worksheet. You can see the beginning value. This is the max total value that this portfolio reached, the date it did so, and a minimum value and date. We can also see on which dates and how much there were the biggest dollar changes. In this case, the positive side and the negative side. Okay. Also, of course, what dates those happened. Additionally, you can see the biggest percentage changes to the upside and downside. Again, what dates those happened. In this instance, they were the same dates for the dollar changes, positive and negative, with the percentage changes. As I mentioned, you can enter a dollar threshold here. My portfolio example, there were 28 days that it lost $1,000. 26. There were 17 days that it gained $1,000. Okay, so you can change this to whatever amount, again, would give you anxiety or cause you to lose sleep at night. Let's move it up to 2,500. In this case, there were 2 days that it gained $2,500 in value and 3 that it lost. Okay, the same can be done with a percentage threshold. Change that and decide how comfortable you are with those changes and see how often that happened with your portfolio. Some limitations of the workbook. At this time, the workbook does have some limitations, unfortunately. At some point in the future, I might make modifications to address these issues. The first and most obvious is that there's only room for 5 different assets. If you're good with spreadsheets, you can probably figure out how to add more. This isn't a tool to come up with an optimum decision or an exact forecast. Rather, it's one that generalizes the volatility you might expect to see, emphasis on might, based on your asset allocation and the use of leverage. Assets can be substituted and proxies can be used as needed. The ultimate goal here is to mentally prepare you for the swings in value you might see based on the variables you choose. Speaking of asset allocation, one type of asset not available for analysis is shorting or puts. The formulas are only set up to measure gains from price increases, not decreases. At some point in the future, if the demand is there, I might add that functionality. Creating an investment portfolio that's right for you. With a simplistic workbook, hopefully you can decide how diversified you should or shouldn't be. No other investment guru knows what exactly is right for you. Keep that in mind if you create a scenario that's very volatile. There's a good chance that reality will mimic what you modeled. Perhaps it might even amplify it. So, when things get choppy, look back to this workbook and remind yourself that you anticipated scenarios like this. Remind yourself that, in the end, you will probably still meet your goals. I hope this workbook helps you weather the storm with more confidence. Thanks for watching. That's all I got.